Hello everyone and welcome to another accounting video. Today we will learn about how to identify and analyze business transactions. Okay, essentially what we are doing is to identify the effects of transactions on the business's accounts. Alright, we will be doing this via a few common business transactions. So it will take a little while for you to be familiar, but let's give it a go. Alright, before we even analyze any business transactions, we must always understand that we are looking from the business's point of view. Alright, so let's look at the first transaction. The owner deposited money into business bank. Okay, by now you would know that anytime the business bank is affected, the cash at bank account will be affected, right? So cash at bank from the business perspective will increase. Therefore, cash at bank goes up. Okay, we need to find another effect. Alright, so when the owner deposits money, it is as good as the owner contributing something into the business. Therefore, capital account will also increase. Alright, so we always need to ensure that there are two effects per transaction. Essentially, two accounts will be affected from each business transaction. Okay, so we have already analyzed the first transaction. Let's move on to the second one. Okay, in the second one, the owner withdrew. Okay, so when the owner withdrew, okay, and it mentioned here for personal reason, then what happens here is drawings account will be affected. Okay, that is one effect. Okay, let's look for another effect. Basically, the account to adjust here will be cash at bank because a business check is affected. So when a check is being issued, okay, it will affect the business's cash at bank account and the business will have lesser money in the business bank account. Therefore, cash at bank account decreases. Okay, so we need to put it in a negative column. Alright, moving on. Third transaction, owner contributed. Okay, by now you would know that when there is contribution, capital account will be affected. That's one. Second, laptop. Okay, so a laptop is an office equipment, and when this transaction happens, the business will have more office equipment. Therefore, office equipment will increase. Okay, so we have two accounts affected. We can move on to the final transaction in this page. Okay, next one. Owner took out something for personal reason, right, to give his son. So we would consider this as drawings. So that is one account that is affected. Let's look at another account. We see that there is an office printer, which is a form of electronic, and this account here will be office equipment. So when this transaction happens, the business will have lesser office equipment. Therefore, office equipment will decrease. So again, we have already adjusted two accounts and we have completed our analysis on this transaction here. Okay, so as a recap, there must be two accounts that are affected minimally per transaction. Okay, let's move on. Okay, we'll go on a little bit faster for the next few adjustments or what we call transactions. Okay, business bought goods. So when the business buy goods, goods affects inventory. The inventory account will increase. Next, the business paid a check. Therefore, a check affects cash at bank and there will be lesser money in the bank account. Cash at bank goes down. Next one, business again bought goods. Okay, so goods affects inventory. When the business buy goods, the business has more goods or more inventory. Inventory goes up. Next, this was purchased on credit. That means the business has liaised with the supplier or what we call the trade payable account. So when the business buys on credit, the business will owe the supplier more. So when the business owes the supplier more, trade payable increases. Alright, so we have two accounts. We can proceed. Next one, business bought a lorry. Okay, a lorry affects the motor vehicle account, and since the business buys a motor vehicle, the business has more motor vehicle increases. Again, this was purchased on credit, meaning that they will pay in the future. So the business owes the supplier for buying the lorry. So when the business owes the supplier, the trade payable account will be affected. Since this is an increase in the owing to the supplier, trade payable increases. Next, business bought a van, okay, and we know by now, okay, a van is a type of vehicle. So when a business buys a vehicle, the business has more vehicle, motor vehicle increases. Next, paying via a bank transfer. A bank transfer affects the business bank account, and when they pay from the bank account, there will be lesser money in the business bank account. Therefore, cash at bank decreases. Next, let's move on to more interesting scenarios where it gets a little bit more complicated, but we will still analyze these transactions together. Again, in the next transaction, the business return goods. So when they return goods, the business has lesser goods. So when they have lesser goods, they have lesser inventory. So inventory decreases. However, they receive a check refund, meaning that now they will have more money in the business bank account. Therefore, cash at bank increases because the check refund will go into the business bank account and the business will have more money in the bank account. Okay, next one. Again, the business return goods. So when they return goods, they will have lesser inventory. Previously bought on credit. Okay, so as you see here, previously bought on credit. So this has something to do with the trade payable or the supplier. Okay, since the business returned to the trade payable or to the supplier, this time round the business will owe the supplier lesser. So when the business owes the supplier lesser, trade payable will decrease. Therefore, trade payable goes down in that sense. Okay, moving on, we have the business return a lorry. So we know by now, lorry is motor vehicle. When the business returns the motor vehicle, the business has lesser motor vehicle. Therefore, motor vehicle decreases. Again, this was previously bought on credit, so the supplier is involved, and we are looking at the trade payable account. Okay, by now we know that when the business return the lorry, the business will owe the supplier lesser. So when the business owes the supplier lesser, trade payable will decrease. Okay, last adjustment on this page. Business return a van. Okay, so a van is motor vehicle, so motor vehicle decreases. Okay, previously bought via bank transfer. So when the business previously bought by bank transfer, they would have paid from the bank account and the cash at bank account would have had decreased previously. However, when they are returning this van at this juncture, the business would receive a refund, right? So this refund would go to the business bank account and their bank account balance will increase. Okay, moving on to the last slide on this page or on this video. Okay, move on. Business bought goods. Okay, so when they bought goods, so we know by now goods are inventory. Business has more inventory. Inventory increases. Okay, however, this wasn't purchased paying cash, right? It was purchased on credit, which means the business owes the supplier. Okay, since they owe the supplier, we have to record it in the trade payable account. So trade payable account deals with owing to the supplier. When the business purchase goods on credit, they will owe the supplier more or less. Okay, you guessed it right. Okay, they should owe the supplier more. Okay, next transaction. Business paid a check. Okay, so when they pay a check, the cash at bank account or the money in the bank account will decrease because the business is paying in this case. Okay, and they are paying to the credit supplier, right? They are paying to the credit supplier who is a trade payable. So when the business pays the supplier, the business will owe the supplier lesser. All right, so trade payable decreases. Okay, next transaction here, business return damaged goods. All right, so there's more information given here why they return the goods is damaged. So when the business returned damaged items, the business will have lesser inventory. Okay, and again we see here credit supplier. Okay, by now you should be very familiar that credit supplier will affect the trade payable account. So let's consider what would happen to the owing to the supplier when this happens. So when the business returns some things to the supplier, the business will owe the supplier. That's right, the business will owe the supplier lesser. Okay, final transaction on this page. In this example here, the business made a partial repayment on its owings. So they didn't really mention exactly the word supplier, but we know by now that there is a payment to the supplier. Therefore, the owing to the supplier should go down because the business is paying the supplier. Okay, and since the payment is made by check, so the business's cash at bank account will also decrease in this example. Alright, so you can see that there are many different transactions that were being mentioned in this video. You may want to review some of these transactions again so that you are familiar with not only identifying accounts and translating it into the correct effect. Okay, you may also want to know how to identify it from the business point of view. Alright, I'll see you in the next video.